Good afternoon. Time to check in on the markets with global stocks easing as a whole host of U.S. Fed officials talked up the prospects of higher interest rates. We did have Asian markets lower this morning with the Chinese equities closed for the Golden Week. They will reopen next week. Nonetheless, investors are waiting for the U.S. jobs report in order to assess the resilience of the U.S. economy, in order to be able to gauge the central bank's next move. We did see the rand weakening in early trade with the dollar index up about 0.1%. And this is, measuring the dollar against six major currencies. The rand reaching in 18 rand to the dollar handle. Of course, Brent trading at $94.84 a barrel with oil prices at this point quite steady. But to talk to us about the week that was, we are joined by Warwick Lucas from Galileo Securities. Warwick, thank you so much for your time. Your sense of the JSE's performance and the rand as well ahead of that key jobs report figure?
Okay, so I think we'd had a very positive gain in the US market starting Friday last week, as there had been expectations of personal consumption, expenditure and gross domestic investment, both up in the US as well as contributions from exports to GDP, and this is washed through in the global environment, and we've seen it coming through in the local markets, whether you're talking property indices, resources, bonds, were all looking quite good. I think for me the one disappointment really was the rand, not as firm as I would have liked, but perhaps that just relates to ebbs and flows. So a moderately positive week on the whole.
We have the oil price holding on to gains even after that OPEC Plus announcement. From your perspective, and given everything that we're seeing right now, is there a prospect of a higher oil price, perhaps even $100 towards the end of the year?
Okay, so I think to some degree the old oil order looks like it's flagging that it's back. I think particularly with the choke points that we're seeing in relation to the availability of Russian oil and generally Balkan oils. I mean, it shows that there really is not enough alternative capacity, and generally a lack of historic investment in the sectors is now really starting to come through. And in terms of potential tightening, I mean, the one thing we'd be looking to from China is that if it refires its economy post this whole party congress, which finally, thank heavens, is looming large, we could see a real tightened demand for oil. I mean, right now, we've seen a tight oil market with China effectively absent. When it comes back, well, that could be a different thing entirely.
So let's talk about the Elon Musk Twitter deal. I mean, a lot has changed since April when the deal was announced and now. And I'm wondering, what's your sense of US big tech and the overall environment, in an environment that now Elon Musk has to deal with?
Okay, so I think in big tech, high interest rates have a twofold impact. Firstly, it tends to punish the funding costs, which are often very extensive on a lot of the deals that they do, because they're almost sort of these long-term stories, lots of growth in the future, but right now you have to fund it extensively. And then secondly, it exerts pressure on the long-term value of those future cash flows, i.e., okay, we're going to grow like crazy, but that's long in the future, so we're going to have to pay a lot for it. So what that means is that we have the issue there that really high interest rates squash tech valuations big time. And in terms of Elon Musk and Twitter, it's pretty sure that he overpaid. I mean, just the timing alone was pretty prejudicial. But I think we also have the situation, the market doesn't trust his willingness to go ahead with the deal. He says he will, but the way the market's behaving, it's almost saying, well, I think this guy's got another fight left in him. So quite an interesting space to watch, that one.
I mentioned in my intro, we've got that US jobs report figure. What is the market expecting?
Okay, so from what I can see there, the expectations are currently for something around 250 to 275,000, and it's a pretty important one to watch because an excessively big number would flag a willingness on the part of the Fed to say, right, well, things are still clearly quite hot until we could potentially hike further. So yeah, quite an important one to watch this month around.
We've got less than a minute left. Before I let you go, what are your clients concerned about? Is it high inflation or recession?
Okay, so I could basically say, well, both. That's the scenario called stagflation. I think if we look at the kind of bounces that we saw in markets this week, I mean, it showed a recovery in economic performance and markets bounce accordingly. And I think it does show that certainly in the very micro data, it's important to see anti-recessionary type data, i.e. some kind of recovery. But we certainly don't want to see that combined with really aggressive systemic data that suggests, well, the Fed is going to have to weigh in more on hike rates. It's a real balancing act that we're seeing right now.
Warwick, thank you so much for your time. That is Warwick Lucas from Galileo Securities giving us his perspective on the markets. And we will unpack that US jobs report figure for you and give you the market reaction on Monday when we come back with our market update. And of course, next week, we are opening to US earnings season. So lots to discuss. However, that is it from me. We're going to take a break. When we come back, we'll have SME on point. Stay tuned.